What if I told you that some retirees spending over $150,000 a year pay zero federal income tax in retirement? Yes, you heard that right, zero. And yet, at the very same time, other hardworking couples with the exact same nest egg are paying more in taxes during retirement than they ever did while working. Same savings, same effort, two completely different futures. How does that happen? And more importantly, how do you make sure you end up on the right side of that equation? That's what we're going to unpack today. For those of you who don't know me, my name is Kurt Soupy. I'm a CPA and retirement planner for over 25 years. First, let me start with a real story, and then we will get into some important strategies. A couple came in and asked me 3 questions I hear almost every week. Do we have enough? Can we retire? And how do we pay less in tax? We ran their numbers, their retirement plan, the one they had been told was fine, gave them about a 65% probability of success. Think about that. You work for 40 years, and at the finish line, your odds of running out of money are basically a coin flip. Well, that's terrifying. Now, here's where things changed. We overlaid a tax plan, and then we built a coordinated income plan. We adjusted their investment risk and reduced their fees. And what we created is what I call the retirement success plan. Their probability of success didn't creep up, it skyrocketed to over 95%. And that's the point. Retirement confidence doesn't come from luck or chasing the next hot stock. It comes from strategy. Now let's get back to the heart of the issue, because the real danger most retirees face isn't whether they've saved enough, it's how much of that money the IRS is going to take once you start pulling it out. And here's the problem almost every retiree runs into. During your career, you were told save, save, save in your 401k or your IRA. You got that tax deduction you were promised, and then you thought you were going to be in a lower tax bracket. But here's the truth. That advice hasn't been true for over 30 years. Why? Because when you retire, you lose the deductions that used to protect you. Your kids are grown, your mortgage is paid off, you're no longer contributing to retirement accounts. And then the IRS comes knocking with required minimum distributions, forcing you to pull money out of your 401k or IRA, whether you need it or not. For many retirees, this means higher tax bills in retirement than while working. And if you think taxes are high now, look at the US debt clock, over $37 trillion and counting at the time of this video. Do you believe Congress is going to lower taxes in the future or raise them? Exactly. That's the retirement tax trap, and unless you plan around it, the IRS could end up being your biggest beneficiary. Think about how much in taxes your children could pay if you leave them a taxable account 25 or 30 years from now. Now here's the good news. There are proven strategies that can shift a large portion of your income from taxable to tax-free. Not tax advantaged, not tax efficient, completely tax-free. And when that income doesn't even show up on the front page of your 1040, it means less strain on your portfolio, less worry about running out of money, and more confidence in your future. So let me walk you through 6 ways to build tax-free income in retirement. The first strategy is simple: Roth contributions. And many of you may have heard of this. You pay tax once up front, then every dollar of growth and every withdrawal is tax-free for life. If you're still working, contribute to a Roth 401k or IRA, and don't forget the spousal Roth IRA. Even if your spouse isn't working, you can often fund one on their behalf. Now maybe you're thinking, that sounds great, but I make too much to qualify. That's where the backdoor Roth comes in. Even if your income is too high, you can make after-tax IRA contributions and then convert it to a Roth. Done correctly, this allows high-income earners to keep building tax-free accounts even when the IRS tries to say no. And inside some 401ks, you can even do a mega backdoor Roth, adding tens of thousands of tax-free accounts each year. Then we come to what may be the most powerful strategy of all, Roth conversions. This is where you take money from your pre-tax IRA, pay tax now, and move it into your Roth. Now, at first, that might sound painful. Who wants to pay more tax? But here's why it works. Paying a little tax today can save you from paying a whole lot of tax tomorrow. Because once RMDs start, the IRS forces withdrawals whether you need them or not. And those withdrawals can push your tax bracket, raise Medicare premiums, and make Social Security taxable. Even worse, if you don't use all the money, your kids have to withdraw it in 10 years at what is likely their most highest earning years. By converting strategically in your 60s, you lock in today's historically low tax rates and create a lifetime of tax-free income. And that's how one family we worked with saved over $300,000 in lifetime taxes. And I'll show you how in just a moment. Here's what I want you to hear. You don't have to control Congress. You don't have to predict the market. You don't have to time the economy. What you can control is your plan, your mindset, and your choices. Every time you convert to a Roth, you're reclaiming a piece of the future from the IRS. It's not about perfection, it's about progress. About being one step better prepared today than we were yesterday. Another overlooked tool is the health savings account. If you're eligible, this account gives you a triple tax advantage. You get a tax deduction when you contribute, then the money grows tax-free, and withdrawals from medical expenses are tax-free. And here's a bonus tip. This money grows and compounds tax-free, so avoid temptation to use it now and let it grow. Considering healthcare is one of the largest retirement expenses, funding it with tax-free dollars is an incredible advantage. And don't forget about your home. Under current rules, you can exclude up to $250,000 of sale gains if single, or $500,000 if married filing jointly. So if you bought it for $300,000 and you sell it for $800,000, that $500,000 gain could be entirely tax-free. That's money you can reinvest or use to fund your retirement lifestyle without sending a dime to the IRS. Now, the real magic isn't just doing one of these things, it's weaving them together in the right order at the right time based on your personal tax bracket and income plan. That's how you can shift 40, 50, and even 60% of your retirement income into the tax-free column. Now, let me go back to that family I mentioned earlier. By following conventional wisdom, their projected tax bill in retirement was around $500,000. But by restructuring their plan using Roth conversions, contribution strategies, and asset location, their lifetime tax bill dropped dramatically. Instead of $500,000, they paid about $200,000 up front. Yes, more in the early years, but the net result, potentially millions of dollars in lifetime tax savings as that money grows and compounds tax-free over the next 30 years or more if they leave it to their kids. That's the difference between following conventional wisdom and having a real tax plan. Now let's talk about Jane and Joe. They're 66, retired with about $3 million saved between IRAs, Roths, and taxable brokerage accounts. They want to spend $150,000 a year in retirement. Most people assume they pay tens of thousands in taxes. But by drawing income strategically, here's what happened. $30,000 came from their traditional IRA. $120,000 came from selling investments in their taxable brokerage account. Because of how cost basis works, only $60,000 of that counted as taxable gains. Add in a little dividend income, and their total taxable income landed just over $100,000. Now, after applying the standard deduction, their taxable income was only about $68,000. And that meant their qualified dividends and capital gains fell into the 0% bracket. Result? They spent $150,000 and paid zero federal income tax. If they wanted to be even more strategic, they could layer in Roth conversions before claiming Social Security, paying little to no tax today while reducing future RMDs and building a permanent pool of tax-free income. Here's why this matters. Retirement isn't just about how much you've saved, it's about how much of it you get to keep. Two families can have the exact same nest egg. One spends their retirement anxious about taxes, Medicare penalties, and running out of money. The other spends confidently knowing they've beaten the tax trap. The difference isn't luck, it isn't picking the right stock, it's planning. And the truth is, you are enough and you have enough when you have a plan. Think of retirement like landing a plane. The 5 to 10 years before and after retirement are what we call the retirement red zone. And those are the most dangerous mistakes. And mistakes here can be devastating. Would you ever board a plane without a seasoned pilot in the cockpit? Of course not. That's what we do for our clients. We're the co-pilot, helping you navigate turbulence, taxes, market volatility, healthcare costs, so you can land smoothly into retirement. So here's my challenge for you. Don't let the IRS become your biggest beneficiary. Don't settle for a coin flip chance at retirement success. You have an opportunity right now to take control. Every day you wait is another day the clock ticks closer to higher taxes, RMDs, and missed opportunities. So let me leave you with this. If you've ever wondered, how do I take the money I've saved and turn it into reliable income I can actually live on? That's the question you need to answer next. Click the first link in the description below and book a time with one of our advisors. They'll help guide you through how your lifestyle, assets, and goals come together to shape your retirement income. It could save you years of stress and uncertainty, because retirement isn't about fear, it's about clarity and confidence. and living the life you've worked so hard to build. Thanks for watching.